The Fed lowered interest rates a month and a half ago, and mortgage rates went up. Let's talk about it on the weekly update. Okay, friends, let's talk wrong way rates. That's a tongue twister. Here's what you need to know. First up, since the Fed's initial rate cut, rates have been going the wrong way. Now, I know everyone's excited about earnings season. We want to talk about earnings season. And trust me, I do too. But there just isn't enough data yet to talk about. So we're going to save that for next week when we're going to do all of the Mag 7 together. But what I can tell you, at least at this point, Google's earnings were pretty good, and it's giving a lift to the whole complex. So I actually don't think there's going to be that much to do about this quarter's earnings, particularly for the Mag 7. I think they're going to, do well, all of them. But we'll get to that next week. This week, I want to talk about something that I think is going to be more impactful as time goes on, and that's these wrong way rates. Notice how I got to slow down before I say that. All right, so what do I mean by wrong way rates? I thought that the Federal Reserve was cutting rates and that was good and it was going to give stimulus and all the rest of this. Isn't that what's happening? Well, yes and no. So the Federal Reserve absolutely is cutting rates, and they're cutting rates on the short end of the curve. So where you might feel this, if you have any floating rate debt, you'll feel relief there. Definitely bank deposit rates are affected there. Definitely things like overnight margin rates, maybe things like borrowing through lines of credit. You'll feel, some relief there when the Fed cuts rates. But something interesting that's been happening, I've got the 10-year Treasury here, and what I've highlighted for you is this is September 18th when we cut rates for the first time with a double-barreled cut, remember. It was a 50 basis point move. At that point in time, the low for the 10-year that day was 3.63%. Now, it's been basically a month and a half, and the 10-year rate is now up at 4.25. So we've had a lot of move higher in rates in just a short amount of time. Now, the short-term rate is good. The Fed totally controls the short-term rate, but the Fed absolutely does not control the long-term part of the curve. So this is out of their control. And the 10-year is actually really important because this sets the rate for a lot of different things. Auto loans, furniture lending, potentially even credit cards, and certainly 30-year mortgage, and even beyond the 30-year mortgage, basically any mortgage. And what I'm showing you here, this is from Zillow, and I've got the 30, the 15, and the 5-year ARM fixed here. And what you notice is here's September 18th. You can see it very clearly on the chart. And then since then, rates have been moving higher. Mortgage rates are almost, probably what? 0.75% higher today than where they were when the Fed cut rates. And this is something very interesting that's happening. And this is something that I think is going to impact the market much more strongly as we start to get into January, February, and March of next year. From where we are now, fourth quarter is holiday season. People open their wallets, they spend in good times and bad. But these sorts of things that are happening, rates moving higher, I think is going to be a risk as we start to get into the first quarter of next year. Now, why is this happening? Well, there's two components to long-term rates. And what I'm showing you here, this is what's known as a Fisherian deconstruction. Irving Fisher was the Federal Reserve banker who figured all this out. But basically what he said was, we know short-term rates. The Fed totally controls short-term rates. They can move short-term rates wherever they want them to go. They have total control there. But for long-term rates, there's actually two different pieces at work here. First is the expected path of short-term rates. And so this is, if the Fed is either hiking or cutting, we know the Fed is cutting. But the other component of long-term rates is expected future growth and inflation. And I actually love that he connected these two. It's growth and inflation. And so what that means is it's not giving us a signal, hey, is growth going to be good? Hey, is inflation going to be bad? We actually don't know at this point in time. And so if you look at what's happening to rates right now, short-term rates are absolutely coming down. The Federal Reserve is decreasing short-term rates, and they're expected to do that in the future. But the reason why long-term rates are going higher is because the market is saying, there's going to be more growth and inflation in the future, and therefore long-term rates need to go higher. Really interesting development. If it's growth, that would be great. Super positive. Would be really excited if we got a ton of growth out of this thing. If it's inflation, that's bad. Would be super bad. Would be very nervous about that. And the reality is, for where we sit as of today, right now, we don't actually know. We actually have to go 10 years into the future and then look back and say, okay, did we do good things or bad things when we cut rates 10 years ago? That is the time scale that finance works on. It's way longer than anyone thinks. But this is going to be important because, as we're seeing with mortgage rates and as we're seeing with other things, we're in earnings season right now, and D.R. Horton just reported they had a pretty rough day. They fell 7% yesterday when they reported. Basically, they lowered their guidance, they missed revenue targets, they missed earnings targets, and basically what they said was, hey, homes are expensive, demand is drying up. That rate relief that we were hoping to see from the Fed reducing rates, it's not coming through. So what does this all mean? Wrong way rates? Well, interest rates have been rising since the Fed's supersized rate cut. And paradoxically, long-term rates have been rising despite short-term rates coming down. And this is because the market is pricing in increased growth and inflation expectations. Growth would be good, inflation would be bad. We don't know which it's going to be just yet. But what this does mean is that this means relief probably isn't coming to the industries that need it most. And I'm looking at housing, autos, furniture, consumer durables, big ticket items. They really needed some rate relief. They're not seeing it yet. This could change at any point in time. So this isn't set in stone, but this is what we're seeing. These are the immediate results in the month and a half in the aftermath of the Fed rate cuts. And you probably know this already if you look around in your own life. If you've priced a car recently, priced a mortgage recently, priced anything that requires borrowing, rates haven't come down. And I've got pretty good odds that they've probably gone higher since then. So there you go. That's the news review. I think this is going to be a really important effect 3 months from now. And so I wanted to talk about it today. Next week, we're going to get into all sorts of earnings goodness. I'll see you later. Okay, friends, that was the video. Hope you liked it. If you found it informative, good, entertaining, I'd love if you could scroll down here beneath the video and give me a like there. It helps us out with the algorithm. And then if you want to be notified first of anything new that we upload to the channel, if you come over here, click subscribe. You'll be the first to know as soon as we upload anything. Appreciate it. See you soon.